At Scotiabank, our fourth quarter earnings were up 4% compared to a year ago, with very good performances across our retail and commercial businesses, both in Canada and across our international footprint, both growing double digits. This was partly offset by lower performance in global banking and markets, due primarily to a very strong performance in Q4 of last year, as well as a generally softer capital markets environment in the fourth quarter of this year. This brought our whole year earnings up to 8% growth in 2017. We had very good performance in Canadian banking, which was up 9%, international banking up 15%, and global banking markets were up 16%. Reducing structural costs is a key strategic priority for Scotiabank, and our progress to date has been a good news story. Our expense growth in the fourth quarter of this year was up only 1% compared to a year ago, and for all of 2017, expenses grew only 3%. Reducing structural costs not only drives greater productivity, but also provides funding for our large investments we are making in technology and our digital transformation. Our total technology costs in 2017 of just over $3 billion were up 14% compared to a year ago, and now represent 11% of our total revenues. Scotiabank has had very good success in growing its capital levels over the last 4 years, and our industry-leading capital levels grew even further in Q4. Our key capital ratio, our Common Equity Tier 1 ratio, grew to 11.5%. This allows Scotiabank a lot of flexibility to grow its businesses through ongoing organic growth, reinvestments in the business, as well as through acquisitions that are on strategy. It also allows us to distribute capital back to our shareholders, primarily in the form of dividends, but at times through share buybacks. Scotiabank, over the last 4 years, has generated $30 billion of internally generated capital, primarily through earnings, and we've distributed about 50% of this back to our shareholders. In 2018, Scotiabank is expected to deliver good underlying growth and performances across our businesses and geographies. While there may be some headwinds in 2018 from the translation of our foreign earnings, our diversified business model at Scotiabank will allow us to earn through this headwind, and we are well positioned to grow the bank and grow returns for our shareholders.